morning to wake up to. This is Brad with your No Bull Precious Metals Report. And I don't want to waste too much time, so let's just take the plunge and figure out what's happening today. For starters, we are a day into the revelation that the Fed actually thinks that there's inflation. Can you believe it? Insert the surprised Pikachu face meme right here. In yesterday's announcement, it was kind of like they finally discovered that prices are on the rise. So someone actually at the Fed walked through the grocery store or bought gas or maybe even quoted out a home remodel or something of that nature. It's not like they couldn't have had one of their hundreds of economists who are diligently compiling their hundreds of thousands of reports to tell them that it was actually happening before now. But, the data's been there and they've been playing coy with it. But that's been the party line for months now. Keep everyone calm and hopefully everything kind of blows over. So I have to ask, when has that actually worked? Really, they keep trying and it always seems to blow up in their face, just like it has right now. However, up until now, Wall Street has been buying that line. Sure, they kind of had a raised eyebrow every once in a while when, Powell would get up and talk and he'd say, nothing to see here, everything's fine. But the money machine was still rolling along strong. And it was something that was kind of a mutually beneficial agreement or a pact that, there was a wink, wink, nudge, nudge that, yeah, there's inflation, everything was kind of on shaky ground. But at the same point, everything's good, so we'll just keep playing the game. But last night, all the guys down at Goldman and the other big investment houses looked up from their Bloomberg terminals and let out a collective, oh crap. Then the bloodbath began. So as we start looking at this, just as kind of a recap of what was going on, at 2 p.m. yesterday, silver was at $27.65. It's now on the downward spiral. It's regained a little bit at $26.15. But, I don't care who you are. A $1.50 drop on a sub $30 issue is nothing to sneeze at. That's a huge drop. There's a lot of it that isn't based on fundamentals. It's based off of fear. So with that being said, gold didn't fare much better. Again, at the 2 p.m. mark, which 2 p.m. is right before Powell took the stage and the Fed issued their report. At 2 p.m. it was 1846.90, and it's now sitting at 1782, as you can see on the board. So again, not quite as dramatic of a drop, all things considered, but in context, we're still looking at a decent amount here, especially considering the gains that we've made over probably the last month on gold. But that's not all. If we start looking at the board, we can see that, that there's a lot of softness in the market, especially with softs and grains, metals. All three of those segments are getting hammered this morning. And also what's important to note is that all of these sectors are raw components. So things like oil and gas and meats, they're raw and direct to consumer. So there isn't a significant amount of refinement, processing, value add. They're closer to an end deliverable than would be, say, something like cotton. Not too many people are actually buying just plain cotton. They're buying, cotton shirts or cotton sheets or something that's involving cotton, or say, for example, lumber or, coffee with imports or things of that nature. So, there's a lot of this that kind of goes into it. And you're seeing a lot of those hits within these longer cycle production markets. So essentially, this goes back to what I had shown yesterday. with the industrial production index and especially the import index. By all accounts, those major sectors are softening, and Wall Street's taking notice. When interest rates start to climb, when there's the potential for interest, things of that nature, that's when the street starts getting involved, and they start looking at what are the long-term impacts. Because again, I mean, everyone can talk about conspiracies and everything else, and well, the technicals are saying this and that, but there's a lot of money. There's hundreds of billions of dollars that are spent every year on examining the fundamentals and doing these long-term projections on things. And these aren't stupid people, and they have some of the best computers in the world with some of the best statisticians and mathematicians and everyone else who's involved, so they can start to identify these trends and see what a long-term projection looks like on this. So I tend to look at stuff like this and say, they're probably not just 100% reactionary, although they're probably about 75% reactionary. But that 25% difference is really where everything has to kind of ferret out. And that's kind of where the numbers lie. So where is this all going in the long run? And that's really the great question. Right now, the Fed is predicting inflation in the 3.5% range as we start moving into the second half of the year. They're also predicting that everything will be great come fall because job numbers should surge back. Personally, I have my doubts on both accounts. First, the Fed is operating under the theory that the pandemic and lockdowns essentially suck the air out of the room. As the things are lifted, the air will surge back and stronger than before. That'll cause turbulence and eventually settling into equilibrium. And the turbulence is supposedly what we're seeing right now. However, I think that's wildly optimistic, and it doesn't fall in line with any of the numbers as they're starting to come out. We're currently seeing huge numbers of job openings, but to offset that at the same time, people are leaving their jobs. There's this imbalance that's occurring, and we're seeing many industries they're just unable to find workers. This implies that there's a wage imbalance, especially in the bid ask. A job is offering X amount of dollars per hour. The employee doesn't want it. They want more. So therefore, there's that imbalance. They're not finding that middle ground where they can make a deal. So these positions are staying open. And that in itself is really kind of stopping these inrush currents. Production is slowed. We're also seeing problems in the flow of the imports. Both of these logistics between production and imports, that they're creating the slowdown overall, and just in general, they're not good omens. So the market is starting to understand that, and we're seeing the hits in the areas where the markets think that it makes the most sense. And unfortunately, gold and silver, which is what I'm focused on, they're ground zero in all of this. So with that being said, let's move over into the dashboard. Let's see where things are. Economically, in this week's reports, today is initial jobless claims. We have continuing jobless claims. And all of those are, the continuing jobless claims have stayed steady at 3.52. The initial jobless claims took a pretty good rise again. They were expected to decline, but, we're now 52,000 more than what was expected, which is never good. Initial jobless claims are people who are filing for the first time, while continuing, obviously, are people who are already in the system. The Philadelphia Fed Manufacturing Index, it's less than it was in the previous period. It was expecting to go down. It's up just a little bit at 30.7. The index of leading economic indicators, that's pretty much right in line with where we were, what was predicted, and what is. So all of that comes to fruition. And so as we start looking at things, The important thing to note right here is, again, we've been watching this for a few days, which is the 10-year Treasury rate. We are seeing, after this report, a dramatic spike. So we were yesterday, if you recall, we were at 3.51 or 1.51. Yesterday, we closed at 1.5. Okay, that was fine. But now we're currently trading at 1.56. So we're definitely, moving up from that lower cycle that we had. And we're seeing a pretty decent distribution of trading volume, or high-low price spread. But we are starting to move up into the range where we're going to meet up with the average and the median pretty soon. And that doesn't show good tidings. But enough with that. We can see here, this is the actual numbers as they're trending for the unemployment. We can see that we've got this slight upward trend going on. It doesn't look like much when you zoom in. But, the numbers are the numbers. They're definitely not necessarily heading down in the direction that anyone wants to see. So moving on into silver and gold, and just to kind of show the comparative view here for a second, we can see, the 2 o'clock range. This is exactly where the 2 o'clock was, and now we're sitting right there. We're well below. If I attach on the previous VWAP, yeah, it's all pretty crazy. We're in a state of decline all the way through. Where this will settle, it's hard to say. Have we found the bottom? I don't know. With gold, same type of thing. So we can see from that 2 o'clock range all the way down to where we are now. We approach this, overlay the VWAP onto it. Yeah, again, kind of the same thing. It almost looks like it's, if we look, it almost looks like it's -3 there on the deviations. And then we overlay the intraday and where we are today, and you can see that we're still below. So both of these metals are really taking a pretty decent hit. In comparison, however, we can definitely see the upward trend on the gold-silver ratio. So we can see that silver taking the hit is much more detrimental to that ratio than the gold taking the hit. Because again, yesterday we were at, just picking out a day, we'll say 2 o'clock. If I can get there. Okay, so we were at 66.77 yesterday, and 58.65 on retail. And today, with the adjustments, with the way things have moved, we're at 68.12 and 59.19. So both of these things we can definitely see are affecting that, and hopefully we can reverse that spin. Looking at the market volume, again, this is we saw that spike yesterday. 2 o'clock gold. 115,000. Today we're seeing gold at 8 a.m., 76.5 thousand. Even silver is kind of spiking a little bit after. At 9 a.m. for silver, it was 34.6 thousand. So we're definitely seeing a lot of activity that's going on with that. It's active trading. What can we say? We go into the retail market. And the interesting part here is really this droopy graph. We start going from pretty much the weekend over, and we can see just direct path. I'll go median to median. Yeah, you don't need a level in order to see what direction that's sloping. But it's actually not that bad considering. If you're looking to buy retail silver right now, that's not too bad. We're 30.62 on the low, 32.17 on the high, and really the median is 31.42. So that's pretty decent price considering where we were yesterday. We'll go to 11:30 yesterday. We're at 32.24, 33.87. So I mean, we're definitely a good range for purchasing. Um, I would say there's not much danger of it going too much lower. I mean, especially on the retail side of things, retailers are going to be slow to kind of adjust, and we can even see this over the last the last 12 hours since the start at midnight. Um, One of the things that you can notice is that on zero, as we start at that baseline time, the actual prices themselves, you can see where they start to widen out and differentiate themselves from spot itself. And the movement of spot, as spot went down further and further and further, you can start seeing that certain issues weren't moving quite as fast. They weren't adjusting as fast. So you're starting to see, really retail is putting on the brakes and saying, "Whoa, we're not going to go down that far," which is always interesting with silver because the price of it. When you're dealing with gold, there's a little bit more give and take within the profit margins, things like that. But with silver, I mean, you're dealing with $30 items. $30 items. You figure if there's a $5 range over spot on them between wholesale, retail, everything else, you might be making $1 off of these things. If you're a shop or a distributor or something like that, and especially if you're trying to sell, quote unquote cheapest prices. So there is going to be some braking action that's going to happen as you start looking at all of this, saying, price is starting to decline. Where's it going? Okay, well, we don't want to move it that that fast. So, add in a little bit of a gap on the old algorithm, and the updates aren't going to happen quite as fast, or they aren't going to be quite as aggressive, or anything like that. So, just something to be aware of as you start to look at it. And again, we can see that this is actually taking off a little bit more in relation when we actually just focus right on spot as the baseline, and then we see what the actual changes are that occur throughout it. And as the day goes on, we're starting to see more of an enhanced change that exists, and especially those silver eagles. Silver eagles have been on the decline. If you've been following throughout the course of the week, silver eagles have been on the decline for the week, but that there's a limit to how low they're going to go and how fast they're going to go that low. So again, just things to keep in mind. As we start looking at gold, same story. Really, it is. We can start to zoom in on just this week. We can see exactly what the line is, do the same thing, go from median to median, and that's pretty decent slope. I mean, it's not something I'd want to be roller skating down, but it's an interesting change. And as we start to dive into the gold to retail, the thing that I was talking about is the lines are a little bit closer on. So it's tracking a little bit closer to spot. And again, it's that same thing that I was really kind of talking about with silver, is that the margins are a bit looser. You have a little bit more play in things. You can adjust a little bit closer as price fluctuations occur. So it's not that big of a deal to throw as hard of a brake onto things. And you can see that at certain points, there are certain items that are a little bit more braking, such as the gold buffalo, the Canadian maple, the panda. But really, the buffalo and the maple are the two that are really kind of moving pretty good. Now, the interesting thing that you can notice on here, which is kind of funny, is unlike the other ones, if you see the first two items, we have spot, we have 1 ounce gold, and then we have the American Gold Eagle. So we can see that Gold Eagle is actually tracking a little bit closer to the spot performance than anything else, which is almost the inverse of the way that it was on the silver. And it's much more pronounced as we start looking at it here. We can see first thing in the morning, we got to really about 1400 or so. Everything's moving in unison. But, June 20th, yesterday, all of a sudden that occurred. And, yeah, we start to widen out. All of a sudden, Powell makes his announcement, and everything's like, okay, well, we need to make some changes here, and we need to protect ourselves. Can't blame him for that. But that is the lay of the land for going into this bloodbath Thursday, I'll call it, for metals. My best advice: don't get too freaked out. Things go up, things go down. If you're a savvy investor, you'll make money either way. The most boring time that we can ever have is when things are just nice and level and sideways as they were for the last couple of days. But as we move forward into the week and into the weekend and then next week, there'll be more surprises for us. But hopefully this brings about some sort of an interesting regime change. One, it gives me something to talk about, but two, it also provides many more opportunities to get in, get out, laterally transfer, really think about how you want to make money as you move forward on these things. And again, if you like what I'm doing here, feel free to like, share, subscribe. Leave me a comment. If there's something that you want to hear me talk about more, definitely tell me. If there's something that you are sick of hearing me talk about, feel free to tell me. So until next time, keep stacking and enjoy your day.